A flash, then another, cut across the darkness as air defenses erupted over the horizon. Sirens followed seconds later, too late to matter. Somewhere below, radar screens flickered with targets moving faster than thought. Orders were shouted, then drowned out. Missiles were already inbound. Across the region, ships slowed, then stopped. In the narrow waters of the Strait of Hormuz, captains stared at silent radios and made the same decision at once. Wait. Within hours, nearly all traffic through one of the world's most critical arteries had vanished, and far beyond the blast zones, something else began to move. Oil prices surged, markets jolted awake, currencies slipped, entire economies braced for impact before dawn had even broken. For millions of people, the cost would come later, quietly, in rising bills, shrinking wages, and uncertainty that stretched far beyond the battlefield. But in those same hours, in offices far removed from the smoke and fire, fortunes were already being made. Because war does not affect everyone equally, and the question that follows every escalation is rarely asked out loud. Who, exactly, is winning? By morning, the consequences had already spread far beyond the strike zone, not as explosions, but as numbers. On trading floors in London and New York, screens turned red before most people had even woken up. Oil prices surged within hours, gas futures followed, insurance rates for shipping spiked almost instantly, as if the world had collectively realized how fragile its lifelines really were. The Strait of Hormuz, just a narrow stretch of water on a map, suddenly became the center of global anxiety. Nearly a fifth of the world's oil passes through it, and now, almost nothing was moving. Tanker traffic dropped dramatically. Some estimates suggested a collapse of up to 90% in the first phase of the crisis. Captains waited, insurers hesitated, governments scrambled to understand what came next. Then came the second shock. Qatar, one of the world's largest exporters of liquefied natural gas, halted production indefinitely. Not gradually, not partially, indefinitely. It didn't matter that countries like the UK source little gas directly from the region. Energy markets don't work that way. They are interconnected, reactive, global. A disruption anywhere becomes a price increase everywhere, and so, within days, the impact began to translate into something more tangible. Household bills. For an average family, the increase could reach hundreds of pounds a year. For businesses already operating on thin margins, it meant hard decisions: cut costs, raise prices, or absorb losses. For governments, the timing couldn't have been worse. Economic forecasts had already been weakening. Growth projections were downgraded. Inflation, once expected to ease, now threatened to surge again. Plans for interest rate cuts began to unravel almost overnight. In the UK, a narrow margin of fiscal stability, tens of billions set aside as a buffer, suddenly looked fragile. Markets reflected the uncertainty immediately. Stocks fell, the pound weakened, investors moved cautiously, pulling back as risk spread through the system like a slow, invisible current. And yet, not every chart was falling, not every investor was losing. Because while broad markets dipped and currencies wavered, one sector moved sharply in the opposite direction. Defense. Shares in major military contractors rose within hours of the first strikes. In London, BAE Systems climbed noticeably, defying the downward trend of the wider market. In the United States, the reaction was even more pronounced. Investors weren't reacting to what had happened. They were reacting to what would come next: more production, more contracts, more demand. Because war, in economic terms, is not just destruction, it is also opportunity. And as ordinary people began to calculate what this conflict would cost them, others were already calculating how much it might be worth. By the time the first images of the strikes reached the public, the markets had already made their decision. War had begun, and for some, that meant growth. On Wall Street, the reaction was immediate. Shares in major defense companies surged within hours of the first reports. Lockheed Martin, Northrop Grumman, RTX. Each rose sharply, 4, 5, even 6% in a single trading session. It was a familiar pattern, predictable, almost mechanical, but the scale was harder to ignore. In just one day, the combined value gained by these companies reached tens of billions of dollars. Wealth created not through innovation or productivity, but through the expectation of prolonged conflict. Because modern warfare does not just consume resources, it demands supply. Missiles must be replaced, interceptors replenished, systems upgraded, production lines accelerated. Governments don't hesitate in these moments, they commit. And once those commitments are made, they rarely reverse quickly. Factories run longer, contracts expand, shareholders watch closely. In Europe, the same pattern unfolded. While broader markets struggled under uncertainty, defense firms moved in the opposite direction. In London, BAE Systems climbed as investors anticipated increased military spending. Across the continent, similar companies followed. War, it seemed, had its own economy, one that operated by different rules. In Israel, the effect was even more striking. Elbit Systems, already a major player in defense technology, saw its valuation surge dramatically in the months surrounding the escalation. At one point, it briefly became the most valuable listed company in the country, not despite the conflict, but because of it. And this is where the contradiction begins to take shape, because the same event that destabilizes economies, that raises prices, that pushes millions closer to financial strain, can simultaneously generate enormous concentrated gains, a transfer, not of goods or services, but of advantage. In research, this dynamic has a name: the paradox of incentives. It describes a situation where the very forces that cause harm also create powerful motivations to sustain it, where ending the conflict may be rational for society as a whole, but not for those who benefit from its continuation. And in the case of war, those beneficiaries are rarely visible in the immediate aftermath. They don't appear in the footage. They don't stand in the blast zones. But their presence is felt in rising stock prices, in expanded production targets, in quiet decisions made far from the front lines. None of this means that conflict is created for profit, but it does mean something more subtle and perhaps more difficult to confront. Once war begins, it creates its own momentum, economic, political, even institutional. And that momentum does not always point toward peace. Because for a select group of actors, the continuation of conflict is not just manageable, it is profitable. But weapons manufacturers are only the most visible layer of this system. To understand why wars can persist, even when their costs are undeniable, you have to look beyond the markets and into the incentives of those in power. As missiles fall and markets react, something quieter begins to shift. Attention. In the hours before the strikes, headlines had been moving in a very different direction. Investigations, scandals, questions building around those in power, stories gaining momentum. Then, almost instantly, they vanished. Search trends collapsed, media cycles pivoted. Public focus narrowed to a single overwhelming reality: conflict. War has a way of doing that. It simplifies the world. Complex debates are pushed aside. Nuance disappears. In its place comes urgency, fear, and a sense of collective alignment. A nation under pressure begins to close ranks. This is often called the rally round the flag effect. In moments of external threat, populations tend to support their leaders more strongly, regardless of what came before. Approval ratings rise, criticism softens, opposition hesitates, not because the underlying issues are resolved, but because they are temporarily overshadowed. And for those in power, that shift can be significant. Political pressure eases, scrutiny weakens, time is bought. In some cases, narratives can even be reshaped. A leader facing domestic challenges can suddenly appear decisive, strong, necessary. War reframes perception. It changes what matters, at least for a while. But this effect is not always deliberate, and it is not always sustained. Over time, prolonged conflict can erode support just as quickly as it builds it. Yet in the early stages, the advantage is real, and it creates a difficult question: if conflict can stabilize political standing even temporarily, does that change the incentives around escalation? Around de-escalation? Because decisions at this level are rarely made in isolation. They exist within systems of pressure, public opinion, media cycles, institutional expectations. And when those systems begin to align, even briefly, around conflict, the path forward can narrow. But the most unexpected dynamic lies elsewhere, not in the countries launching strikes, not in the markets reacting to them, but inside the country at the center of it all. Because in Iran, the effects of conflict and pressure have not weakened power structures in the way many might expect. In some cases, they've done the opposite. From the outside, pressure on a country is supposed to weaken it: sanctions, isolation, economic strain. The logic seems simple. Cut off resources and power begins to fracture. But inside Iran, something very different has happened. Over the past decade, as sanctions tightened and foreign companies withdrew, space began to open inside the economy. Gaps formed, industries left without partners, supply chains disrupted, markets cut off from the outside world. And into that space stepped a single force: the Islamic Revolutionary Guard Corps. Originally created to defend the revolution, the IRGC has evolved into something far more complex. A military organization, yes, but also a vast economic network: construction, energy, telecommunications, agriculture, infrastructure. Entire sectors now sit, directly or indirectly, under its influence. In some estimates, the organization is connected to a significant share of the country's economy through subsidiaries, contracts, and informal networks that extend far beyond what is officially visible. But its most critical asset lies elsewhere: oil. Despite years of sanctions designed to restrict exports, Iran has continued to sell its most valuable resource, not openly, not through traditional channels, but through systems built specifically to bypass restrictions: shadow fleets, front companies, ship-to-ship transfers in open water, and at the center of those systems, the IRGC. Today, experts estimate that the organization controls up to half of Iran's oil exports, a dramatic increase over just a few years. That control is not just economic, it is power. Because in a sanctioned economy, access becomes everything: access to foreign currency, to trade routes, to information, to protection, and those who control access control the system. What was intended to weaken the state has, in many ways, strengthened the most resilient parts of it. As formal institutions struggled to adapt, the IRGC, built for flexibility, secrecy, and survival, expanded. It became better at operating in isolation, better at navigating risk, better at turning restriction into opportunity. And while this consolidation took place at the top, the cost was felt elsewhere. Between 2011 and 2020, millions of ordinary Iranians were pushed into poverty as sanctions tightened and the economy contracted. Prices rose, jobs disappeared, stability eroded. But power did not disperse, it concentrated. Because crises do not affect all parts of a system equally. They filter through it, strengthening some structures while weakening others. And in Iran, the structures that adapted most effectively were not necessarily the ones the sanctions were meant to target, which creates a difficult reality. The same pressures designed to force change can instead reinforce the status quo, even entrench it, and when that happens, the idea that external pressure alone can reshape a system begins to break down. Because the system has already adjusted, already hardened, already learned how to survive, and in some ways, how to benefit. But the ripple effects of this conflict do not stop at borders. They move outward into something even larger, a system where instability itself can reshape the balance of power. The global energy market. While the conflict unfolds on land and in the air, its most immediate and far-reaching effects move through something less visible: energy. Not the explosions, not the headlines, but the flow of oil and gas, the system that powers economies far removed from the battlefield. And when that system is disrupted, the consequences are felt everywhere. Almost instantly, prices begin to rise, not because supply has fully disappeared, but because uncertainty has. Markets don't wait for shortages, they react to risk, to the possibility that tomorrow might be worse than today, and in that gap between fear and reality, opportunities emerge. For the United States, the shift is significant. Over the past decade, it has become one of the world's largest energy exporters, particularly in liquefied natural gas. And as instability spreads across the Middle East, Europe's reliance on American energy deepens, not by design in this moment, but as a direct consequence of it. More demand, higher prices, expanded influence, energy once again becomes leverage. In the Gulf, the picture is more complex. Countries like Saudi Arabia and the United Arab Emirates hold something few others do: spare production capacity, the ability to increase output when others cannot. But even more important is how they export it. Unlike some of their neighbors, they have invested heavily in infrastructure that bypasses the Strait of Hormuz entirely. Pipelines that carry oil across land, avoiding the very choke point now under threat, which means that while others are constrained, they remain flexible, less exposed, more resilient, and in a volatile market, resilience becomes advantage. Elsewhere, the effects ripple outward in less obvious ways. For Russia, the disruption creates an opening. As traditional buyers look to avoid instability in the Gulf, they begin to shift toward alternative suppliers, toward discounted oil, toward routes that feel, at least temporarily, more predictable. China, India, large price-sensitive markets begin to adjust their flows, not out of loyalty, but out of necessity. And in doing so, they reshape the balance of global demand. What begins as a regional conflict becomes a global realignment, one where energy is not just consumed, but repositioned, redirected, and, in some cases, quietly weaponized. But the consequences don't stop at geopolitics. They reach into something even more long-term. Because as prices rise and profits follow, another system begins to shift, one that was already under pressure, the transition away from fossil fuels. And in this moment, it becomes harder, not easier, to move forward. For years, the direction seemed clear. A gradual shift away from fossil fuels, toward renewables, toward a different kind of energy system, cleaner, more stable, less dependent on volatile regions. But moments like this complicate that path. Because when oil and gas prices rise sharply, something changes, not in theory, but in incentives. Suddenly, projects that once seemed too expensive become profitable again. New drilling, new exploration, infrastructure that might have been phased out is reconsidered, extended, expanded. What was once a declining industry begins to look attractive, and capital follows. Investment flows not toward the future, but back into the present, into systems already built, already understood, already generating returns. At the same time, governments face pressure. Energy security becomes urgent, immediate, political. Keeping the lights on matters more than long-term transition goals. Short-term stability takes priority over long-term transformation, and so decisions are made, practical, understandable decisions that nonetheless slow the broader shift. More supply, more fossil fuel reliance, more dependence on the very system that created the vulnerability in the first place. This is the contradiction. The same crisis that highlights the risks of relying on oil and gas also makes those resources more valuable than ever. And when something becomes more valuable, it becomes harder to replace. The transition doesn't stop, but it hesitates. It bends under pressure, because the incentives once again are divided. On one side, the long-term need for change. On the other, the immediate rewards of staying the course. And in that tension, progress slows, not because the direction is unclear, but because the system, as it stands, still has too much to gain from remaining exactly as it is. If war creates incentives to continue, then ending it requires something difficult, changing those incentives, not in theory, but in systems that are already deeply entrenched. One proposal is simple, at least on the surface: a windfall tax. If companies generate extraordinary profits during times of conflict, profits directly tied to instability, then a portion of those gains could be redirected back into public budgets, into relief, into stabilization. It's not a new idea. Governments have already applied similar measures to energy companies during periods of price surges. Extending that logic to defense contractors would follow the same principle. If crisis creates profit, then profit should carry responsibility. But implementation is far from straightforward. These industries are powerful, politically connected, often framed as essential to national security, and drawing clear lines between necessary defense and opportunistic gain is not always easy. Another lever lies in the energy markets themselves. Coordinated action, like the release of strategic reserves, can soften price spikes. It has been done before. Large-scale interventions designed to stabilize supply and prevent panic from driving prices even higher. But these are temporary measures. They treat the symptom, not the structure. The deeper question is political. How do you limit the advantages that conflict provides to those in power? Stronger democratic institutions can help. Independent oversight, a free press, systems that continue to function, even under pressure. Because when scrutiny remains intact, the window for exploiting crisis narrows. But these conditions cannot always be imposed from the outside. They depend on internal resilience, on how societies choose to govern themselves, especially when tested. And then there's the most difficult challenge of all, the one that stretches beyond any single conflict. As long as economies remain tied, directly or indirectly, to the profits of war, to arms production, to fossil fuel dependency, the incentives will persist. Not always visibly, not always intentionally, but consistently. Which means breaking the cycle is not about a single decision or a single policy. It is about alignment, shifting the system so that stability becomes more valuable than disruption, so that peace is not just desirable, but profitable. In the end, the costs of war are easy to see. They appear in razroushed cities, in rising prices, in families adjusting quietly to a world that has become just a little more uncertain. They spread across economies, across borders, across lives that had no part in the decisions that led here. But the benefits are harder to trace. They don't appear in headlines the same way. They don't arrive with noise or fire. They accumulate, quietly, selectively, within systems built to absorb and adapt to crisis. And that is what makes this conflict so difficult to resolve. Because the actors with the greatest influence over its outcome are not all experiencing it as a loss. Some are gaining. And as long as that remains true, the path to peace will never be shaped by consequences alone. Only when the balance shifts, when stability becomes more valuable than disruption, does the logic begin to change. Until then, war will continue to create its own reasons to endure.